Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 4 o'clock in New York on Tuesday, the 25th day of March 2014, and this is the daily report for gold and silver. Mixed bag in the precious metals markets, with platinum and palladium trading lower today, gold and silver trading higher today, although nominally higher. 1310.70, that's the print we see on the screen. 1306.20 on the low, 1319.60 on the high. Current print puts it up $1 to $2 in terms of its current on the day, Silver also trading higher, nominally though, up about 5 to 7 cents, 19.95 current print, low 85, 19.85, and the high 20.31. More on silver towards the end of the show. Traders, we're looking at a classic market scenario and a classic question in terms of our current retracement. When we consider that this market really sold off towards November of last year, hits this low of 1181, we get this $200 rally. To see the market retrace is not something that is not only uncommon, but it's really something that is to be expected. The key is what is an acceptable retracement level? Where do we start looking for a bottom? Could we have possibly hit that bottom? And to answer that, of course, the first thing we want to do is look at the area. Now, we have identified the area of roughly 12, 13, 12, 12 as an area that 13, 11, 13, 12 is an area that we feel should provide some support. We talked about the fact that we had a double really Fibonacci number, and the key to that number was that what we saw was on the long fib level, which is the one that I'm putting up right now, the 38% retracement level took us to about 1311. You can see that right here. We're trading just underneath that at 1310. When we did a secondary fib retracement, and the secondary one was really from this area here all the way up, what we found is that 1313 came in as a number as a 50% retracement. So all in all, when we consider the fact that the market has rallied, roughly $200, and then retraces from that approximately 38%, this is absolutely an area that we want to look at to see if the market can find some support. Interestingly enough, it has been trading lower, and we have not gotten any effective closes at or above 1311 to 1313, because that's that band or that area we're looking at. Below that, you really have to look at right at around 1300. And my sense is right now we haven't had that kind of downside pressure. Let's put that in as a line. We haven't had that kind of downside pressure as of yet, but we've not really gotten any kind of concrete confirmation that we have hit some sort of potential support in this area. And the reason that that's important is we're going to look at these daily charts and intraday charts for the first indication, because when we start looking at some of the outer charts, meaning 2-week charts, even our weekly chart and our 9-day chart are still showing us a pretty bearish tendency. I've gone ahead and pulled up our 2-week chart. We've used this chart most recently to define majors in the market, M4, M3, M2, M1. I believe that we're probably just entering a major fifth. The key is on this chart, when we look at it, is the fact that as the market comes down, you get these pivot points at critical areas where the market tends to turn. They're going to be shorter term though, however. And the reason they're going to be shorter term is because we're looking at a two-week chart. You can see here, you get that real critical pivot point. You can see that pivot point right in here, in which you've had these solid, strong green candles as the market moves to the upside. And then you get this really pivotal candle, and it really defines a pivot point. You can see that pivot point down here. Here, not so much. On this particular bottom, you did get smaller bodies, but you didn't get that really, really small bodied. And I do need to point out that you do get them in places where the market is simply consolidating. So, market's in a downtrend here. This, of course, is that dramatic fall from about 1435 down to the second of our double bottom here. But you can see that in the center of this drop, you had that one small 2-week period where it actually opened and then closed above the midpoint of the prior candle. So with that in light, I draw your attention to our current candlestick that we have. This, of course, is in Japanese average format, but you can see it absolutely could be a pivotal candle, meaning we could be looking at the market coming up, making a play, and we could be looking at a retracement that is going to be deeper than the one we're currently experiencing. This is the first point that I feel real comfortable looking at it and looking at it in terms of a conservative call, not an aggressive call, but a conservative call in the market. We're still going to need to see absolute confirmation. We haven't gotten that yet. Now, of course, it's absolutely important that when we look at these candles, we look at the candles through the eyes of what I call a standard candlestick chart and a Japanese average candlestick chart. They both have very similar features, but they have a key distinction. And the key distinction, more than anything else, is the fact that the standard candlestick charts have true opens and closes. So what you're looking at on a 9-day chart, for example, is where it opens on the first day, which would be on this red candle up here, the high of the 9 days, the low of the 9 days, and where it closed on the 9th day. Now, when we look at this particular chart, again, this is a 9-day chart, but interesting activity because we have the series of green candles. You've got a pretty large size bodied candle when you compare them to the previous ones. You then get this doji, which is absolutely gapped in the center of it. And then you get a red candle, but it's almost a shooting star when you consider that the tail, it's not quite 3 times the length of the body, but it is at probably most likely double the length. So I'll call it shooting star-esque or shooting star variation. It doesn't meet the exact criteria, but when we look at this particular pattern, this also is a pattern that's telling us we could be looking at lower pricing. So as I said, it is a little bit too early to tell. We don't get confirmation, and the outer months are showing us the potential for lower pricing. But realize that these outer candles, meaning the longer durations of candles, are always going to lag behind your daily, your 3-day, and of course your intraday works and studies. So I take it with a pretty big grain of salt. So traders, we've looked at a 9-day, we've looked at a 2-week, we've looked at a 9-day, a 2-week, a daily, intraday. This is just the weekly, and I draw your attention on the weekly because on the weekly charts, we can see our dramatic ascent. We can also see these last 2 weeks, and really the characteristics are you get a pattern simply called an engulfing bearish here. You do get your confirmation on your weekly here. So that's also signaling the potential for lower pricing. However, we're at that one point that we really want to look at to see whether or not we find some support in the market in this area. And then lastly, in terms of gold charts for today's show, I want to look at, this is a daily. This is the continuous contract of COMEX. Very, very similar to the activity we saw on the cash chart. And what really sticks out is the fact that we are in fact still trading. This is that band I talked about. Call it 1314 to 1313 right in here. And this is that harmonics that we spoke about, 38% level on the longer of the fib retracements, and then 1314, that's a 50% retracement that starts from here and goes to the top. So my concern is that we are still trading underneath this, and as long as we do, I have to label it as a level of resistance in the market until we can effectively see a close over that. Support in the market, really, we've got to look at these intraday lows here, and then we've got to look in terms of a fib level right at around 1300, because you get 1296 and 1289. So we get another band right in here between these 2 points. More effectively, it's a lot more narrow than that. This would be your real level of support just below $1,300 per ounce. And to silver, looking at a 240-minute chart in silver, really in terms of areas that I've been pegging, really 1986, 61% retracement, we'll draw the arrow across. When we do that, we can see even on the short-term basis, this of course is about mid-January here, market comes up, we get real resistance in this area, resistance being about 2050. We've seen this happen before, and 19 on the low side. This is that range-bound market that we saw. Here's the breakout of the market as terms of when it breaks out of the range. And without a question of a doubt, this is what I'm currently pegging at support at around 1985. We can see that there were a series of bottoms here, but historically speaking, there's not a ton of activity right here, but it is a Fibonacci-based number, and it is where we are currently pegging our support. We're going to maintain silver. We're going to stand on the sidelines looking for a place to enter with gold. Most importantly, with gold, we're going to see if we can start to see effective closes above 1311 to 1313. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow on Wednesday for another daily update and review. Bye-bye.